Hello, and welcome back to another episode of Medi's Digital Classroom, streaming live every Tuesday. If you joined us last week, you would have learned the ins and outs of securely storing private keys. If you missed that episode, make sure to check it out after today's session. And oh, if reading's more your style, all our content is available in blog format as well. Just find the links in the description below. So, let's dive into today's topic, shall we? Imagine being in a universe where those golden coins from Super Mario, yes, the very ones you desperately jumped for, actually held real-world value. Or better yet, you could use them for transactions, or perhaps as an investment. Sounds exhilarating, right? Or maybe just a tad outlandish. But in the cryptocurrency domain, this fantasy isn't far from the truth. My friends, today we're venturing into the mesmerizing world of tokenomics. But what exactly is tokenomics? Simply put, it's a delightful fusion of tokens and economics. But it's not merely about the technology behind cryptocurrencies. Instead, it's a deep dive into the economics of it. Imagine peeling an enormous crypto onion layer by layer. And don't worry, the only tears you might shed would be from checking the occasionally unpredictable price charts. At the heart of tokenomics is the creation, distribution, and management of the tokens in a cryptocurrency. It goes beyond mere numbers or intricate algorithms. The real challenge: building an environment where these tokens carry genuine value, serve a purpose, and, most crucially, are motivated by elements that support both use and longevity. Remember those days trading Pokemon cards on the school grounds? Some cards were precious due to their rarity, some for their power, and a few, well, just because they looked nifty. Drawing a parallel, in our crypto realm, tokens gain value from various elements: their practicality, rarity, and the ongoing demand and supply dynamics. And the twist: sometimes folks crave a token purely because it's the talk of the town. Digital age peer pressure at its finest. Alright, we've dipped our toes into the basics of tokenomics. But let's explore why grasping the valuation of these digital treasures is absolutely pivotal. Picture this: you're at an art auction. There's this peculiar painting on display. Looks like Picasso had a wild dream, or perhaps a toddler's enthusiastic scribble. And to your astonishment, a couple of attendees start a fierce bidding duel, elevating its value to a whopping $1 million. You might think, that surely can't be its worth. But here's the catch. In both art and crypto, the value can be rather subjective. The valuation of these digital assets is so crucial because it offers a tangible measure, almost like a yardstick, to determine if a cryptocurrency is priced too high or too low. Consider it your navigational tool as you sail the stormy waters of the crypto ocean. And trust me, without this tool, you might just be swayed by the towering waves of overhype. Remember, folks, knowledge is your superpower here. Grasping why a token is priced the way it is can equip you to make enlightened choices. Blindly investing based on your buddy's sister's pet sitter's advice? Not the best strategy. Unless, of course, that pet sitter happens to be a crypto whiz. Then, by all means, heed their wisdom. In essence, discerning the underlying principles of digital asset valuation is like distinguishing the masterpieces from mere scribbles in the vast crypto gallery. I mean, you wouldn't want to pour all your savings into something, only to later realize it was merely a fleeting craze, right? Alright, dear viewers, we'll dive deeper into this after a short break to give you the chance to give us a thumbs up, share, and subscribe. Alright, crypto enthusiasts, imagine you've been transported to the wild west of the digital age. Here, instead of gunslingers displaying their prowess in duels and prospectors hoping to strike gold, we've got metrics and data. And galloping ahead of the rest on a majestic valuation steed is our trusted market capitalization. Or if you're in the know, market cap, and for the super savvy among us, just MC. Let's ride along and get to know this powerhouse metric a little better, shall we? So what exactly is market capitalization? In the conventional financial landscape, a company's market capitalization is determined by multiplying its stock price with the total number of shares they have out in the wild. This gives us a rough idea of what the company might be worth. Now, shift gears to the crypto dimension, and this concept remains largely unchanged. Swap out stock prices for token prices and outstanding shares for the total number of tokens. So our trusty formula becomes token price times total number of tokens. Now let's serve you a slice of analogy. If you thought of a cryptocurrency as a pizza, then the token price is akin to the price of an individual slice, while the market cap represents the value of the entire pie. A slice from a gourmet truffle pizza might cost more than one from your local pizzeria. But if the Truffle Delight has just 4 slices and your neighborhood pizza is a whopping 24 slices, then the total cost, or MC, of each pie tells a different story about their value. Diving deeper. If our MC was a coin, it'd definitely be a two-sided one. Side 1. Total market cap. Think of this as the valuation of the entire pizza, including slices that are yet to be baked or are set aside for later. It represents the value of all tokens in existence, even those not in active circulation. And side 2, circulating market cap. This only looks at tokens that are actively being traded or held by us, the public. Using our ongoing pizza analogy, it's like valuing the slices that are out on plates, leaving out those still baking or reserved for later. But just like the moon doesn't really influence our pizza cravings, though it'd be amusing if it did, market cap isn't influenced by lunar phases. Instead, its 2 primary influencers are token price fluctuations. Any change in the token's price naturally tweaks the market cap. And supply changes. Tokens can pop into existence, minted, or vanish into the ether, burned, modifying the total number available. It's as if you have a magic wand to conjure up or make pizza slices disappear. The specifics behind these price and supply influencers will be unpacked later, so stay tuned. Wondering where you can spot the market caps of various projects? Well, the digital realm is overflowing with information. Platforms like CoinMarketCap, CoinGecko, and CryptoCompare are to the crypto universe what Yelp is to foodies, just minus the mouth-watering brunch photos. However, in this expansive digital west, not everything is as straightforward as it seems. The decentralized nature of crypto can make data validation feel like decoding a cryptic message from a pizza place boasting world's best pizza. Who's validating that? With some tokens lacking third-party audits, we often see unconfirmed supply tags, while others resort to self-reporting, much like our unchecked pizza claims. The sheer volume of valuation requests, coupled with the potential risk of endorsing dubious tokens, leaves tracking platforms treading on thin ice. Missteps might make them accountable, akin to a critic mistakenly praising a less-than-stellar diner. Addressing this influx, these platforms often roll out strict, sometimes perplexing listing criteria. And while decentralization in the crypto realm is empowering, it also necessitates enhanced clarity and vigilance. Because while everyone yearns for their share of the crypto pie, unexpected surprises can leave a sour taste. If you chance upon a token that's blowing its own trumpet about its supply, always tread with caution and cross-verify. You can typically turn to token trackers like Etherscan or BSScan that pull data directly from the blockchain. For those well acquainted with smart contracts, it's possible to determine if a token supply has an upper limit. Pinning down the exact circulating supply, however, can be a bit tricky. Always make it a point to glance through any available audit reports. And just as a word to the wise, steer away from tokens that self-report without a corresponding audit to back them up. Alright folks, so you've heard of the tantalizing prospects of turning your investment into 10 or 100 or even 1,000 times its original value in the crypto space, right? It sounds almost like magic, doesn't it? But here's the catch. While the allure of these exponential gains is undeniably irresistible, diving into these waters requires a keen understanding, especially when our trusty market capitalization, or market cap as we've learned, comes into play. Let's embark on a journey through the realms of these potential gains, with market cap as our compass. First and foremost, let's recall what market cap is all about. Picture it as a product of the token's supply and its price. It's like trying to find the total value of all the apples in an orchard by multiplying the number of apples with the price of a single apple. Next, when you're eyeing a 10x price growth for a token, you're essentially forecasting that the market cap will skyrocket tenfold. So imagine you have a token priced at $1. and there are 1 billion of these tokens in circulation. If its price jumps to $10, the MC would soar to a whopping $10 billion. Now, the $1,000,000, or should I say $1 billion question is, does this project have the strong fundamentals, a dedicated team, and a clear roadmap that would merit such a meteoric rise in market value? How about 100 billion or a trillion valuation? Probably not. But wait, our investigation doesn't end there. Future supply considerations are a critical piece of this puzzle. Predicting a token's trajectory isn't just about its current status, it's similar to forecasting the weather. You have to factor in various elements that might change. In the crypto universe, some of these elements include major unlocks. It's like when your friends promise to bring snacks to your party, but arrive fashionably late. Some projects have arrangements where initial supporters, like our venture capitalist pals, keep their tokens on a leash, only releasing them after a set duration. When these tokens eventually hit the market en masse, the supply amplifies, which might pull the token price downwards. Unrestricted minting. Imagine a magician endlessly pulling rabbits out of a hat. Some projects have the power to continually create new tokens. Such unrestricted token generation can swell the supply, potentially watering down the token's worth. Do note, it's quite common for tokens to have higher inflation rates in their infancy. Yet, if the token's demand doesn't match up, this could cause its price to tumble. Over time, seasoned tokens usually hover around an inflation rate of slightly under 10% to maintain their potential for price growth. Furthermore, always remember the value of comparative analysis. If you were to evaluate a pizza place, you'd likely compare it with other pizza joints in town, right? Similarly, inspect the market caps of projects that share the same aspirations and scale. If your project of interest has a market cap of $1 million, but its peers with similar offerings are boasting market caps around $500 million, then there might be untapped growth potential lurking. To wrap up this segment, using market cap as a yardstick to gauge a token's growth prospects is a sturdy strategy. However, always bear in mind that even tokens with sky-high valuations might offer enticing short-term returns. But as we trek along the long and winding path of investments, the MC will inevitably sync up with a valuation that truly mirrors its worth. So are you ready to navigate the intriguing maze of potential crypto gains with MC as your guiding light? Let's continue this exhilarating journey. We now venture into the realm of token supply dynamics. It's a land where intriguing models meet mathematics, sprinkled with a hint of high school algebra nostalgia. But don't be daunted. We're about to make this as easy as pie, or should I say, cake. You see, comprehending the supply of a token is much like baking a cake. You need the right ingredients in the right proportions. But predicting its demand? Well, that's more like forecasting which dessert will become the next big sensation. But we'll save that tantalizing topic for our next segment. Now let's dive into the heart of our current discussion, the Great Limit Debate. Ever heard of capped and uncapped models? Let's break it down. With capped models, think of tokens as rare pieces of art. They're exclusive, and once they're out there, that's all there is. A shining example would be our famous Bitcoin, boasting a limited supply of just 21 million coins. Such scarcity can act as a catalyst, potentially propelling prices upward, especially if demand keeps up or even grows. And the beauty of this model? Estimating its market capitalization is relatively straightforward. On the flip side, we have the uncapped models, the uncharted territories that echo to infinity and beyond. Unlike their capped counterparts, these tokens have no set ceiling. Now, while this might sound like a boon for project longevity, it does come with the potential shadow of inflation. And when it comes to crunching numbers for market capitalization, let's just say it's a tad more challenging, especially when a project can, on a whim, produce a gazillion tokens and flood the market. Not the most delightful scenario, is it? But wait, there's more. Not all tokens are created equal. We've got max supply, total supply, and circulating supply to consider. Picture this. Max supply is like a grand concert hall's seating capacity. Once all seats are occupied, no more guests can be accommodated. Total supply? That's the tickets sold, but some attendees are still out in the foyer, maybe grabbing a snack or two. And circulating supply? These are our eager beavers, seated and eagerly anticipating the concert's kickoff. And a pro tip, multiply these figures by the token price and voila, you have the respective market caps. But hold on, ever heard of inflationary and deflationary models? It's the classic saga of expansion versus contraction. Inflationary models are akin to towns that keep expanding, building more homes as the population increases. This ensures everyone has a roof over their heads, but individual property values might wane. On the other hand, deflationary models are where the token pool dwindles over time, perhaps due to mechanisms like token burning. Imagine a town where houses occasionally disappear, making the remaining ones all the more cherished. However, let's clear a common misconception. Burning tokens doesn't always equate to deflation. Case in point, Ethereum. Despite initiating token burns, they're on the cusp of inflation. That's because while some tokens face the fire, new ones are simultaneously minted as rewards. And Ethereum is doing an extremely good job in burning tokens compared to others. Now let's tackle a burning question. Where do all these tokens originate? Enter minting. It's the crypto equivalent of a central bank printing money, sans the tangible feel of banknotes. And oh, vesting schedules? Think of them as tokens playing hard to get, released bit by bit to ensure market stability, unless the bid a tiny bit too big and the token market cap inflates too much. And who could forget the crypto halftime shows? Halvings. Thanks to Bitcoin, we know these events slash rewards by 50%, thereby curbing token creation. From forks to token burns, various other elements can sway token supply. It's paramount always to be in the loop and familiarize yourself with official project documentation. With the supply side hopefully now clearer than a crystal ball, gear up as we next dive into the swirling currents of token demand and pricing. As we venture further into the world of tokens, think of token price dynamics as a beautifully choreographed ballet. It's a dance, a harmonious synchronization between supply and demand, with different factors gracefully guiding their every twirl and leap. So, let's lace up our dance shoes and prepare to be enthralled by this captivating performance. At the heart of this dance is the timeless tango of supply versus demand. Picture a vibrant market scene. When there's an abundance of apples, or in our case tokens, with only a few buyers yearning for them, some apples might find themselves overlooked, resulting in their price plummeting. But when apples are rare and every market goer has their eye on them, that's when every apple becomes a treasure and its value soars. But who, you might wonder, directs these dancers? What factors craft the choreography? Well, dear viewers, there are a few star choreographers in our ballet. Different tokens dance to different tunes. Let's explore. Staking is like snapping up a VIP ticket to an exclusive dance show. Token holders lock away their tokens, lured by the promise of returns. This not only guarantees potential rewards, but also takes those tokens off the dance floor, reducing the circulating supply and possibly amplifying demand. But beware, as with any enthralling performance, there might be an encore, leading to unstaking and potentially affecting the token's price. Payment tokens? They're the golden tickets granting entry to elite events within a network. Essential for accessing certain services, their mere necessity can kick up demand. However, these tokens might not always steal the limelight when it comes to significant price movement. Governance tokens offer backstage access. Holders don't just spectate, they influence the playlist. Much like staking, having a say in the project keeps users engaged, ensuring these tokens are held close. Equity shares in our dance analogy? Imagine owning a piece of the ballet company itself. These tokens are tied to a project's triumphs and tribulations, echoing the potential returns of a company's equity. And then there's speculation, the adrenaline-charged breakdancing of the token world. Many hope that their chosen token will be the next sensation, bringing in a flood of enthusiasts. It's this very speculation that often contributes to the wild fluctuations we witness in token prices. Yet, no performance is complete without a stage, and that's where marketing strategies and regulatory landscapes come in. Tokens might be brimming with potential, but they need a spotlight. Effective marketing is like a grand stage, illuminating these tokens for the world to see. But remember, every dance has its rules. Regulatory frameworks can either enhance the choreography or introduce unforeseen challenges, potentially affecting our token's graceful movements. Beyond our grand ballroom, there's a vast world with its own rhythm, the global economy. Broader economic trends can significantly influence our ballet. In uncertain times, some investors might prefer the classical tunes of traditional assets, leaving our crypto dance floor sparse. Conversely, when the economic music is upbeat and lively, the hall could be packed, with everyone eager to join the dance. As we glide through this enthralling world of token prices, always remember the dance's intricacies. Every factor, every move plays a part. Utility. It's not just about having a function or a purpose, but the type of utility a token offers is truly what gives it its unique rhythm in the dance of the crypto world. When we talk about the speed at which tokens change hands, or their velocity, utility plays the leading role. Think of it this way. If a token's utility is primarily to be used as payment in a decentralized app, or dApp for the cool kids, it's like those fast-paced dance numbers. Users get the token and almost instantly part with it. Imagine a token named Flashcoin, zipping around, barely touching the dance floor before it's off again, resulting in what we call high velocity. But then, on the other end, we have the slow, soulful ballads. These are tokens designed to be held, to be cherished over time. Staking is the classic example here. Users keep their tokens tucked away, waiting for the crescendo of rewards. Similarly, governance tokens are like the members of a dance committee. They have a say in the music, the theme, the very essence of the dance. Naturally, they're not too keen on letting go of that influence, hence they hold on to their tokens. These tokens, let's call them Slow Groove Coin, move at a relaxed pace, showcasing lower velocity. Now here's a fun twist. A slower token velocity can be a bit like a limited edition dance move. Just as a rare move can attract attention and applause, a token being held onto longer can apply upward pressure on its value. It's all about creating that buzz, that scarcity. When people are not in a hurry to part with their tokens, it's like they're forming an exclusive dance circle, which could make others want in even more, driving up the token's price. Before you leap into the world of new cryptocurrency projects, always twirl around this question. What's this token's primary move? I mean, utility, and how's that going to influence its dance pace or velocity? Whether it's a flash coin or a slow groove coin, knowing the rhythm can give you invaluable insights into its potential path. As our dance begins to wind down for today, it's clear that while the supply dance steps can often be rehearsed and predicted, demand is that freestyling dancer on the floor, unpredictable yet mesmerizing. Truly understanding token pricing requires not just knowing the steps but feeling the music. It's a blend of precision and passion. But wait, don't hang up those dancing shoes just yet. We've got more groove coming your way. Next week, we'll pirouette into topics like diverse token launches, advanced valuation choreographies, and of course, a little shimmy spotlighting MetFi tokenomics. So stay nimble, stay curious, and keep jiving to those blockchain rhythms. And remember, the best dances always leave you wanting more. Hit that like now.